When you first look at a trading chart, it can honestly just seem like a bunch of random squiggles, total chaos. But for a trader, this isn't noise at all. It's a language. And it's a language that speaks about money, about fear, and about opportunity. So today, we're going to dive in and decode it. See, every single one of these peaks and valleys, every red and green bar, it tells a story. It's the story of a constant battle between buyers and sellers. And it's really easy to fall into the trap of thinking, hey, if I can just learn the vocabulary, all the special patterns and indicators, then I can predict the future. But what if I told you that's not even close to the whole story? I mean, think about it. Knowing every word in the dictionary doesn't automatically make you a great novelist, right? Today, we're going to explore what really separates the pros from everyone else. Is it just about memorizing more patterns? Or is it about understanding the fundamental rules of the game itself? All right, so this brings us to our first big idea, building what's called a statistical edge. The best way to think about this is like cooking. You can have all the best knives and pans in the world, but if you don't have a recipe, you're just throwing stuff in a pot and hoping for the best. So first, let's look at the tools. A trader's toolbox is just overflowing with hundreds of different chart patterns and indicators. I'm sure you've heard of some of these, right? Like a head and shoulders pattern or the RSI. These are like the individual words, the raw ingredients, and yeah, they can be useful, but by themselves, they are not a trading system. They're just tools.
Okay, so this is where we go from just a single ingredient to a full-on recipe. This is just one example of a strategy called an order block. Notice it's not just one pattern. It's a whole step-by-step process for trying to find that statistical edge. Let's take a super quick look at how it works.
So here's the basic idea. First, a trader spots a really strong move down. Then they look back and find the very last green candle right before that massive red drop. That specific little candle, that's the key. And then you just draw a box around that last green candle. That zone becomes your order block. Now, the whole theory here is that big institutions, we're talking banks, hedge funds, placed huge orders right in that spot. So if the price comes back up to that zone, it might have a predictable reaction. See? It's a full recipe, not just one ingredient. So you've got your recipe, your strategy. You're all set to make money, right? Well, not so fast. Because having a strategy is still only one part of this whole puzzle. And the real secret, the thing that actually determines if you're profitable, it's not on the charts at all. It's in the math. This quote right here gets to the absolute heart of professional trading. This is a massive mindset shift. The goal isn't to be right all the time. The goal is to run a system that makes money over hundreds of trades. And that all comes down to one core concept: positive expectancy. Okay, positive expectancy. It sounds a little intimidating, but the formula is actually pretty simple. It tells you if your system is actually profitable over the long haul. And it's not just about your win rate. It's a balance between how often you win and how much you win, versus how often you lose and how much you lose. And here's the kicker. That balance is way more important than just having a high win rate. And this is where it gets kind of mind-bending. Check this out. System A wins 80% of the time. I mean, that sounds incredible, doesn't it? You'd think you'd be printing money. But because the average loss is so much bigger than the average win, this system actually loses $1 on average for every single trade it takes. This is the high win rate trap, and so many people fall into it. So here's the reality for a lot of pros, and it might shock you. Their win rates, they're often not that amazing. Sometimes they're hovering around 50%, sometimes even less. They're profitable because the other side of that expectancy formula is tilted heavily in their favor. Their winners are way, way bigger than their losers. They don't have to be right all the time. They just need to be right big and wrong small. And that idea leads us directly to the final and, maybe the most important pillar of trading like a pro. If you're going to lose 40, 50, maybe 60% of the time, you have to be prepared mentally and financially for losing streaks. This is not a sign that you're failing. It's a statistical guarantee. I want you to let this one really sink in. A drawdown, that's just a period where your account balance is going down. It's not something you should try to avoid. It is the unavoidable cost of doing business in the markets. It's the price of admission you have to pay for your profitable system to eventually play out. Trying to find a system that never loses is just a fantasy. And hey, if you need proof, just look at the raw numbers. The math doesn't lie. This table shows you the probability of hitting a losing streak over 50 trades. Just look at the rows for different win rates. You'll see that even traders with a super high win rate are pretty much guaranteed to have losses stack up against them. Let's just pull one number out of here, because this is absolutely wild. A trader with a totally average 50% win rate, basically a coin flip, has a 95.2% chance of having at least 4 losses in a row over just 50 trades. It is not a question of if it will happen, it's a question of when. And this is what that statistical reality actually looks like. This is a simulation of a profitable system's account balance over time. It doesn't go up in a nice, smooth, straight line, no way. It's a series of peaks and valleys. The whole key is that over time, the trend is up, but you absolutely must be able to survive those valleys to get to the next peak. So, how do we tie this all together? It starts to become pretty clear that successful trading isn't about finding some magical pattern or being a market genius who can predict the future. It's really a game of statistics, discipline, and maybe most importantly, survival. It all boils down to these 3 pillars. Number 1, you need a system with a statistical edge. Number 2, you have to prove that edge is real with positive expectancy math. And number 3, you must have the risk management and the discipline to survive the bad times long enough for your edge to actually work. This is basically the professional's cheat sheet. They are not staring at charts hoping for a gut feeling. No, they are running a business. They are calculating their expectancy. They know the odds of a losing streak, and they manage their risk on every single trade so that no one loss, or even a string of losses, can take them out of the game. So we'll leave you with this. The next time you look at a chart, stop asking, where is the price going to go? Ask yourself a much, much better question. How do I build a system, a business that's designed to profit from its edge while being tough enough to survive its inevitable losses? That shift in perspective, that is what truly decodes the market's language.